the YouTube video now. Give a quick reintroduction to myself, and then we'll get into the good stuff. Hello, everybody. My name is Jackson Pineau. I am your Director of Public Affairs here at Minneapolis Area Realtors, and I am so excited to bring to you all, whether here live or on our YouTube recording, the latest housing market update, recapping the last 3 months as well as so far what's gone on in the year. But I think we've had a lot of changes, both, internally, externally, the world, and I want to start at ground zero here for us, talking about our research team. Um, like I said, my name's Jackson. I got a great research analyst in Gavin Mikulski, who is still in our first year here at MAR, and he's been making a ton of these slides. I wanted to give him a quick shout out. Thank you, Gavin, for contributing to this webinar. He is part of a great team at MAR that is bringing a bunch of services to you. That way, you guys know that member value, why it's worth being a MAR member. In addition to him, I wanted to quickly just shout out our newsletter. In case you don't get it on a Monday morning, please keep your eye out in your email to cover the latest and greatest what's going on at MAR, from the latest RPAC endorsements. Elections are coming up. If you want to know more about the candidates, you can click the link in this newsletter to learn more about the candidates endorsed by our Government Affairs Committee, led by our Government Affairs Director Miles on staff, as well as our chair and vice chairs of the committee. We have some upcoming events for you from the DEI committee, Real Talk in Real Estate, coming up on October 25th here at MAR. It's a great conversation. If you're interested, make sure to register there. It's spooky season, everybody, and I'm not just talking about the politics. The YPN committee has their House of Horrors from Spooky to Sustainable event going on October 29th. And just in case you were still eager for more committee events, we have our Awards and Community Engagement Committee that is having a volunteer event hosted by the great people over at Prism that we partner with. If you're interested in volunteering, we'd love to have you there November 5th, 10 to noon. There are always committees going on throughout the year. These are already past us now at the time of recording, but keep your eye out if you're interested. Upcoming classes, again, bias override that just recently closed up. It was a great class. If you were there, thank you for attending. 21st, negotiate the deal, and then your required mod on the 23rd. But we know why you guys are here. You're here for the market data, right? So let's hop into that market data. Let's take a look at what we want you to be focusing on. We're going to start off quick with our economy and with our recent showing trends data, and finish things off with the Twin Cities housing market charts that we all know and love. I want you all to use this information to, first and foremost, stay informed for your own business practices. I want to make sure this helps you get a leg up in the market. And of course, the best way to do that, share these insights with your clients, with your colleagues. Make sure that you are that expert in the real estate market that people are looking for, right? So let's jump into it. Starting off spicy, as I say here, let's look at the larger economy because there have been some things going on in the news, sometimes too much going on in the news. Um, at the time it was written, there was threat of a possible government shutdown, but it has been confirmed. In case you've been living under a rock, the federal government has been in shutdown since the start of the month, and NAR wants to make sure that you are prepared. There is a link which I will pass along with the charts here that goes into detail about how NAR can help you stay informed about what's going on with the government shutdown. The key takeaways here, because not everything in the government relates to housing, but the key things that I want you to be paying attention to here are, namely, flood insurance. While the government is shut down, The applications to submit claims with the National Flood Insurance Program will be submitted, but they will not be responded to because that staff is not there. Luckily enough, the little graphic that I have right here is not of the current Atlantic coast, so our colleagues in the southeast don't have to worry as readily as this picture leads it to believe. But we all know that floods can happen anywhere along the river here in the Twin Cities, in areas all over the country that are flood prone. You might be working with clients who do live in a flood prone area. Keep that in mind. If the worst happens in the time period while the government is shut down, and at the time of recording, it is still shut down, the response to flood insurance claims will not be responded to until it's back up and running. FHA is another matter. Luckily, the way in which the current shutdown is working out, there are reduced staff at FHA, which means that if you're working with a client who wants a government-backed loan for their home offer, um, FHA can respond, but they are on a skeleton crew. So much like the TSA and other parts of the government that are still up and running, they're running at a slower capacity. Longer wait times there, expect them. And a final aspect that's most related to the housing industry here, USDA loans. That program is on hold. You can submit your USDA loan applications, but it is really pending government shutdown. So it's more of a niche thing, right? The rural area loans through the USDA, but uh, again, slower wait times because of this, and no response from USDA and flood insurance until the government is back up and running. And part of this conversation around the government shutdown, if you all have been watching the news, is talking about federal employees, their unemployment, their furloughing, the firings that have been happening. Um, let's separate the news hype from the stats that I love to talk about. I'm more than happy to talk about news hype on a different, day. But let's talk about the measurables here. Unemployment rate here in Minneapolis, St. Paul, Bloomington, MSA. You can see that it has gone up from like 2.5, 3% to 4% recently. And by recently, I want to kind of clarify a little technical problem here with this type of slide. The label is at the end of the year, not at the beginning of the year. So it looks like we're just looking at 2024, but really we're looking that empty space to the right. Here, I'll get my little laser pointer here. Laser pointer. The empty space here, that's all of 2025, right? So that uptick, yes, has coincided around the same time, the later half of this year. But that rise up to 4% is not necessarily all because of the federal government shutting down, right? There are furloughed employees, there are employees that are working without pay. This is more about just the pure economics. We are seeing a slight increase in unemployment here in the Twin Cities. That is matching, it's about on par with what I've been seeing at the national level. So just because you're looking at our metro area doesn't mean it's any different from the overall measurement of unemployment here nationwide. Just brought this up because it's hyper focused in the local area. Pay attention to unemployment. It is not necessarily a problem right now. It is just going up, something to be aware of. So, let's talk about tariffs. Tariffs is something that has been showing up in the news frequently, right? And it is, in an unbiased manner, it is fair to say that the president's administration and tactic around tariffs is noticeably different than his predecessor or in the recent use of tariffs. Tariffs are a very powerful tool that a president or the Senate can use as a threat and very infrequently actually acted upon. That is not necessarily the case in this year. Tariffs have been implemented, taken back, threatened, implemented again. much more active, much more dynamic. One very important article that came out here from a mixture of Urban Institute and Brookings shows that recent tariffs can threaten residential construction, namely an order that was imposed just earlier this week on October 14th that shows a 10% tariff on softwood timber and lumber, 25% tariff on unupholstered wooden products, and again a 25% tariff on kitchen cabinets and vanities, starting again on October 14th, is going to have some measurable impact on residential construction. This Brookings article does make a point to say that it is counterintuitive with the president's executive order at the beginning of this administration, saying that he wants to see a reduction in the cost of building homes and more affordability in home ownership, which I think we all want, right? This concrete tariff usage is counterproductive to that type of narrative, unfortunately. Why? Because the current state of play and the way we source most of our lumber here in the United States comes from our friends to the North, Canada, the largest of our trading partners across all goods and services at about 17% as of last year. So, how have tariffs actually impacted lumber and housing goods? By the data that I'm looking at, not much yet. Again, the labels are shifted off, right? So 2024 ended right here, and so we are where my red cursor is about the beginning of 2025. And you can see that yes, there is a slight uptick. If you're just localized on the far right end of our screen here, there is a slight incline from the start of 2025. And I imagine a portion of that has to do with tariffs. Now, let's put things into scale here. Compared to the environmental, and I mean economically environmental, like ubiquitous, all impactful change that happened in 2020, you can see that marginal increase is not comparable to the generational shift that we saw in the cost of residential construction goods from 2020 to 2022. And look how stable, relatively, it has been ever since. This shape, I know the index is something we don't relatively need to talk about. It's the relative increase that we are seeing from 2020 to 2022. That is the big change. There have been some changes due to tariffs, and I imagine there will be more. The impact of tariffs is not seen overnight. It's seen in months and years if they last long enough, right? It's trickle down economics, but with international trade in so many ways. What's a much more sensitive tool that we see? Consumer price index. And we are now looking at it in terms of, the percent of year over year change, still over the same time period. And you can see from the end of 2024, we've been relatively in the, let's use big old air quotes, success range that the Federal Reserve wants us to be in. We want the economy to grow over time. Things need to get more expensive over time because of that. If we didn't have consumer prices grow over time, we wouldn't see the economy grow, right? But we don't want them to grow at a rate that we saw in 2021, 2022, 9% year over year growth. That's unsustainable, right? 2, 3%. That is about where we feel comfortable as an economy. Keep that idea of slow growth. That's a trend towards the end of this economic segment that I want us to be paying attention to, right? 3%, that's good. And shifting into, again, the context of new housing, right? Housing goods have gone up a little bit, but not too much. let's take a look at the concrete use of this right here. New construction market share, the percentage of all sales that were new constructions here in the Twin Cities. This is your North Star MLS market data in a year-to-date format. So each of these are looking at their respective years, and so far to this day, comparing apples to apples, what's been the market share of new construction. And you can see we're lagging a little bit behind at about 11% of all homes sold so far this year have been new construction as measured in North Star. We're a little bit behind where we were in 2024, a little bit behind in 2023, but ahead of 2022. So, yes, we are seeing a little bit of give and take here, not a dramatic drop off, not a dramatic gain. Let's talk about the big indicator here, the 30-year fixed rate mortgage average in the United States that we are all really crossing our fingers and hoping it's gonna come back down, right? We just heard, for those of you who have been paying attention, the tiniest little bit of a reduction in the Federal Reserve's effective savings rate has been dropped. When that happens, there is a slightly more incentive for banks to loan out money at lower interest rates because they're getting a worse deal when they put their money in the Federal Reserve. But that little dip has caused the anticipation machine of our economy to drop from a average of what 6.8 it was at the beginning of September to down to 6.3 as a average across the country. And now we're all keenly waiting for this to drop back down. But let's go back to the basics here and talk about why inflation was such a problem. Why this in 2021, 2022 was such a problem. So, we know if there are few products in a given market, things are really expensive, right? Um, Super fancy cars, that designer custom aspects of homes. How about your gas is more ubiquitous. It's all we all go for 87 for the most part. But maybe that, bougie bread that you have at the grocery store is a little bit more expensive than the standard shelf loaf, right? Well, money is treated exactly the same way. We can either have more of it in the economy or less of it in the economy, right? We call less of that money in the economy deflation. When there's fewer dollars in the economy, that means things feel relatively more expensive. From a business side of things, we might see more layoffs because we can't, as a business, afford for the services of that labor. From the home's perspective, bills feel more expensive because there's less money to go around, and those services feel relatively more expensive. And that good old adage of hiding money away under the mattress comes from this idea of the dollar feels more valuable because there's less of it to go around. It's a rarer commodity, right? And in the inverse, this is the thing we're really worried about, right? Inflation. When there's too much money in the economy, we see people not value that dollar as much, more quick to spend on large capital items like cars and homes and anything. And you might remember going to Target or Walmart in the past 5 years and seeing shelves empty. That's because relative to those goods, the value of those dollars were much less from an economic sense, right? So, the Federal Reserve has a faucet, essentially. They have the ability to have the flow of money come in. They can either have a little bit of money enter into banks and credit unions and financial institutions and out to the people, disseminating across, like we see here, or they can have a lot of it come out. And we have seen the slightest switch of saying, okay, more money can go out into the economy. It doesn't need to be pent up here in the Federal Reserve effectively, right? Now, we need to have a word of caution about this, right? And our word of caution is coming from none other than Minneapolis Federal Reserve President Neil Kashkari, who just recently presented here in the Twin Cities at the University of Minnesota, where he said there's only so much money to go around. That concept of we are just adding a little bit more money into the mix, right? And the amount of cash flowing into AI, though it's propping up the US economy, means less to invest in housing. That's a lot to unpack here. So let's unpack it in a way that makes sense to our industry here, right? So let's start with the news shocking aspect of it. Billions, hundreds of billions of dollars is being spent in AI investments. Here is a fun graphic I caught from CNBC of let's just take a look at these four companies investing hundreds or tens of billions of dollars. And there's a reason why I'm stopping at Meta, no shade to Apple or Tesla here, because $60 billion is a really interesting metric. Let's take that 60 billion, 70, 80, or 100 billion and compare it to large bank consumer mortgage originations, new originations that have been created. And you can see that uh, as we have gotten into this is updated on an annual basis here. Through the end of 2024, we have seen a drop from new originations of consumer mortgages, right? Just residential consumer mortgages from large banks. Why large banks? Because large banks are more likely, pragmatically, to make that choice. You know, your local credit union is not going to be choosing between should I invest billions of dollars in AI or divide that up amongst, billions of dollars of potential consumer mortgage originations, right? But banks like Wells Fargo will. And look at where they were in 2021, 2022, when interest rates were low and demand for homes were really high, and prior to the pandemic at 100 billion. We're at around 50 billion below each of these Amazon, Microsoft, Alphabet, Meta, and you know that a portion of these invested dollars comes from financial institutions, right? They didn't necessarily have the money themselves, they took out loans. Where are they using all of this money? What's the theory here, right? AI infrastructure, data servers, power systems, cooling systems. Skepticism exists around these, but there is a hope that this will lead to the next revolution that will spur economic growth for potentially a generation, right? Now, I mentioned skepticism. There is skepticism around the promise of AI versus a more traditional financial evaluation of the market. And I'm closing this off to warn everybody here about the idea that some people are credibly saying that this could be a modern day dot-com bubble because we're not properly evaluating productivity in AI terms appropriately. The jury is truly out. I don't want to naysay AI because it really could be worth all of this type of investment, right? But the truth is, we really don't know. So let's go back to something we do know and back to something I asked you to remember around the speed of how quickly we want to get back into a faster housing market, right? Yes, we do have this very real competition really of a different industry, an AI-based industry that is taking a lot of funds right now that potentially from a financial perspective could be a better, more greater return on investment than offering a variety of different packages or a certain scale of support for originations in the home mortgage portion of a financial firm's portfolio, right? But let's get down to the brass tacks of this. If we try to drive the economy faster than its potential to grow, its potential to produce, then prices will just go up across the economy. Again, another quote from Neil Kashkari, president of the Minneapolis Federal Reserve, right? His main takeaway is patience if there is demand in the area, which we'll get to here in just a second, we'll be just fine. So, takeaways from the economy. We took up a good chunk, but it's exciting stuff, right? Um, Buyer's perspective, let's just recap here. FHA and USDA loans have been impacted due to the shutdown. So if you got a buyer who's in either of those situations, patience, set expectations appropriately, make sure that they are aware of the nuances with the government shutdown and how it impacts their ability to finance, right? Seller's side, if you are working with a client and they just recently are now owning that home and you know that there was flood insurance involved in that way, make sure that they're aware of the impact of the government shutdown on flood insurance coverage as well, right? Back to the buyer side, mortgage interest rates are easing down, and I'm using that word easing down, not dropping, right? Because I don't want to give you the imagery that we are all of a sudden going to get to like 5.5% by the end of the year. I would be surprised if that was the case. AI investment is that main competitor, so to speak, in terms of where's a financial institution going to be choosing to loan out their resources, right? And keep in mind, just in the back of your head, this idea of interpreting an an entire economy being propped up by a very small, there are so many different ways in which people can spend money. One particular advancement can either be a generationally good thing or it could be a high risk, right? One failure, and if it's all standing on one leg, right, falling over, right? Um, Seller side, finishing up there, material costs are likely to rise due to tariffs, not necessarily quickly, but keep that in mind. You will see that over time if these tariffs continue. And unemployment is worth your attention, but not at an alarm right now. So, I didn't mention this at the beginning of this recording. For those of you joining us live, I see the chat. If you got any questions now about the economy, feel free to type them in. I'm going to keep going. I will keep an eye on them. We will stop if you have those questions. I'm going to dive into some of those recent trends. Feel free to use that chat. For those of you watching on our recorded YouTube channel, use that comment section. We pay attention to it. If there is a question, it won't be an instant response, but I will try to get back to you. So, recent showing activity trends from our great friends over at Showing Time. You know, we provide this data to you on a weekly basis if you subscribe to that newsletter. But if you don't, here is the latest. We are currently in the line that is darkest, the black line right here, relative to 2024 in that navy blue, and we have a 5-year average line that is slightly above all of this because in the past 5 years, showing activity was a little hot, right? So, how are we faring so far? Honestly, compared to last year, we started off a little weaker and we have been marginally the same, if not a little bit better. It looks like our summer showing activity was marked improved compared to where we were this time last year or the summer of last year, and that has continued through into the fall. But let's be honest, we are going to start seeing seasonal decreases in showing activity, and that is fairly expected, right? In terms of percentage change, just looking at last week compared to the same week a year prior, you can see that consistency is really the name of the game. Yes, there are percentage decreases in the more affordable end of the spectrum and percentage increases in the market rate and above end of the spectrum, but fairly comparable. And I will say, if you haven't been watching this week in and week out in our blog, this is fairly representative of what we've seen. And to me, that shows 1 point for stability. Let's see if we can keep a tally going of how many points how many times I will say stability. I think I've at least said it twice now. Um, Greatest change in given price segments, we can see here the $500,000 to $600,000 range. In our most frequently shown price range, the three to $400,000 range, we are just about even with where we're at. 18,000 homes shown last week, up 1.5% from same time last year. Now, the big inverse correlation that we like to bring up here is that percent change in showings here in navy blue as compared to the fixed rate mortgage average across the United States. And as you know, well, yes, right now we were at 6.3 at the time we recorded this on Monday. It was about 6.4-ish, but you can see the widening gap appear between the fixed rate mortgage going down, and as it goes down, our change of showing activity increases ever so slightly. Seems as though there was a correction here at the beginning of or at the end of September. Um, Not quite sure what that is, but there's always a bit of a delay. The more people learn about fixed rate mortgage uh, declines, the more likely they're able to call you all up and say, hey, let's pay attention to my showing desires, right? Watch this as it continues because who knows? We might see a furthering of, more appealing mortgage interest rates, and people are more willing to call you up and say, hey, I want to take a look at that showing. Um, a final point here, and this is a great visual, which sometimes is a little wonky. The pending sales to new listings ratio, essentially, as it describes here, a value of 90% means there were 90 pending sales for every 100 new listings. It's kind of an inverted way to think of month supply of inventory, right? That balance between supply and demand. And I love to bring it in around this time of year because it's always about now, at least for the past 5 years, where we start to really fine tune when the seasonal decrease is about to happen. So, in the next couple of weeks, if you start really feeling, wow, it's just not as busy as it was last month, it's really starting to feel more like the season than it is the economy, right? That drifting up means that there are higher percentages of pending sales for every new listing, right? And people are gobbling up the rest of the remaining inventory. There are fewer people willing to list on their home in that fourth quarter. You all know that, but here's a way to reaffirm it for yourself. Alrighty. Don't see any questions about the economy. If you have any questions about showing activity, please, by all means, throw those in the chat as well. Let's take a look at our local housing market in the fundamental metrics that we all know and love. First, taking a look at closed sales, and we're going to take that annual view looking at September of 25 all the way back to September of 2018. So each of these are roughly comparing apples to apples, right, in terms of seasonality. We are up 9% from this time last year of 4,150 homes closed in September of 2025 compared to 3,800 closed in September of 24. And it's a good sign to see we are starting to come back up from a multi-year decrease from the height of the pandemic, even in the late, do you still call September a summer month? I don't know, early fall month, maybe, right? Depending on how hot it is. But this isn't just the only way to look at this. Let's zoom in and look at the quarterly report. That seasonal shift is now kind of separated here in looking at the last 3 months, July, August, September. And some of you data nerds might be seeing error bars or error field here, and I'm so proud of the work Gavin put in to make this visual happen. My dreams of showing you all tests of statistical significance are one step closer. For the stats nerds in the room, the green field is showing you one standard deviation away from the mean. If your eyes just glazed over at me saying that, put simply, If any of the bar charts, the teal or navy blue charts, fall outside of the green area, there's something to be paying attention to here, either above the average, or below the average. And if it's inside that green area, we are, yes, there's a difference between the 10-year average, which is that solid green line, but it's kind of like, your kid and their friend saying one of them's taller when one of them's 5'2" and the other one's 5'4". Yes, one of you is 2 inches taller, but just because there is a difference, you are both basically the same height, right? That green area is here to kind of give you that bit of caution that just because you see a difference doesn't necessarily mean that that difference is something to cheer about or freak out about. So, is there a difference worth being cautious of? Frankly, yes. In terms of closed sales, we are noticeably below. Keep in mind, I'm not saying meaningfully below. Stats nerds in the room, it is one standard deviation away, not two, right? But there is something here. There is a difference between September's closed sales and the 10-year average. We're still up. Like I showed you in the last chart, we're still up 9% compared to September of 24, but compared to the 10 years and all the hype, we are outside of that range. You know that it's okay and it's fair to assess that we are in a lower equilibrium of market demand compared to that 10-year average, right? Let's continue this train of thought and take a look at new listings, right? Pre-COVID, 68, 7,000 homes listed in the months of September. We went up, we went down, we've recovered a bit, right? September saw 63, 6,400 new listings this year, up 5.7% from September of last year. Looking into the stats nerdy seasonal chart that we have, you can see something markedly different here, right? We are now kind of crossing over into this green field. So yes, we are down from a 10-year average, right? The 10-year average is somewhere closer to 6,500. But we're still within this green field. Yes, it is lower, but September is that 5'2" person and the average is 5'4". There is a difference, but it's not meaningfully different in any way. It's showing us again consistency, stability, another indicator to us that there is an expected amount of trust in the market that people are willing to list their homes, right? So, takeaways for sales and new listing. Buyer's perspective, there is less competition, right? Because those closed sales were below the green field, right? There's less competition, but more sales than last year, right? We are trending up slowly, but surely we are trending back up into a more normal time in terms of market demand. But on the other hand, there is increased new listings. We are back to normal, so to speak. And that is something to be aware of. The consistency with the supply of new homes coming into the market in terms of new listings has been consistent for a while. And I am pretty confident that, save for something like the AI market bubble happening, like my tinfoil hat theory leads us to believe from earlier, then we're going to be fine with our supply of new listings, right? Tinfoil hat fully off, right? Mortgages are lowering compared to this time last month. It could be unlocking more demand. We will see, right? Seller's perspective, there's stability in our current demand, although there's lower demand. Fully admit we are at a more soft buyer activity space than we were 7 years ago, right? But that stability still is good to see. There's a cooling of the summer market. That's more seasonality than anything else. But silver lining here, potentially partially offset by lower interest rates. Let's flip to median sales price and negotiation percentages here to talk about how We are faring on the monetary side of things. We are up 2.6% compared to this time last year, and it looks like 2.5% is pretty much the growth pattern ever since we have fully realized the economic monetary policy that was designed to combat inflation, right? We went from increasing at 6% in the months of September year over year to increasing in double digits. That was the snowballing effect, the fact that our economy was growing too fast in terms of price, right? And then we have seen this marginal growth of 2.5 to some cases, depending on the month, 3 or 4%, but marginal growth comparatively, right? I have gotten rid of the field because it's just makes more sense in terms of monetary references here to think of it in terms of 20-year average, 3.5% growth, and think of the green tic tac here as if the blue bar were to be at a 3.5% growth, the blue bar would match up perfectly to the tic tac. We are below each of these green tic tacs for the months of July, August, and September. So our median sales price is not growing at the same rate as the 20-year historic average. If we were to put the green field error bars in here, it would all be within the green field. It was more distracting than anything else. So I'm choosing to leave it out. But this shows us that there is still room to grow in terms of median sales price and the pace at which it grows over time. Let's take a look at the average percent of list price received to talk about a different aspect of this, right? So, negotiations existed prior to the pandemic, where the average percent of a listing price that was received was somewhere around 98, 99% of that original listing price. 2021 or 2020 and 2021 negotiations really didn't exist. And then we return back to a world where negotiations are fairly consistent again. We have about 98.5% of the original list price was received at closing for the month of September for all closed sales, right? When we get into the seasonal 3 month look back here, you can see that's below the 10-year average, but it's still well within historic trends within that green field here that I'm not too concerned. This to me looks like a point of, again, stability that yes, negotiations are back. Buyers are meeting sellers where they're at, and they are finding a way to close that deal, although a little under that 10-year average. Takeaways for your buyers. Prices are growing at a pace close to the historic average. But like we were saying, diminished year over year price, we are going to see prices return back probably closer to that 3.5% average in time. So please do not wait in order to try to find a home. The speed of price growth will likely come back into play here. Negotiations are similar to last year. They're slightly favoring the buyer, right? But it's within that historical trends. Negotiations are more frequent, but tracks with history from the seller's perspective. And final thing, really just important aspect here, sellers or agents working with sellers set local expectations for negotiation and pricing. Ask questions of our research team. Email us at research@mplsrealtor.com if you have questions about hyper-localized market, because not all aspects of the market are exactly the same. We have tons of tools to help you find the answers that you're looking for, and we want to make sure that you have those resources available for you. Final points here in terms of pace of the market and inventory. We have median days on market. This is cumulative median days on market. And you can see kind of a V-shaped formation that exists here for the past 7 years. Pre-pandemic, we were half of all homes getting to a signed purchase agreement in about 3 weeks. Even in September, for the COVID years, we were seeing half of all homes get to PAs in 2 weeks. And then we have come back out into a similar reality of 3 weeks, half of all homes sell, at least get their pending sale status by the third week. Up 14%, so 14% slower technically compared to September of last year. But again, a slower pace of the market does not necessarily mean that it is a slow market, right? It's all relative, which is why we are trying so hard to put in reference points for you that are bigger than just comparing this year to last year or this month to last month, because that's helpful, but greater context is even more helpful. And you can see 10-year average, all of these are pretty dead on consistent with that 10-year average. Yes, we're a slightly slower market than we were this time last year and compared to that 10-year average, but we are well within the standard deviation that we see in this green field. That to me, again, another point for consistency, right? Final area of interest here, month supply of inventory. Again, we can see that there is a V shape trajectory that is happening from 2.7 months supply of inventory down to 1.5 months supply of inventory up to now 2.8 again. And it is just such a similar story around the idea of month supply of inventory and your expectations for your sellers is the key thing here, right? Let's look at one thing, and I do want to bring this up just to bring in a historical context because some of you might think, hey, we're back up to 2.8 months supply of inventory, and therefore this is a balanced market. And there is a competing discourse that is happening right now in this idea of what is a balanced market. I'm hearing it a lot from you all because normally, as a stats guy, I would show you this chart and I would say a balanced market has to be at a minimum of 4 months supply of inventory, right? 4 months supply of inventory is, yes, the academic standard, the research standard, people much smarter than me in economics and housing market data reaffirm that, right? But I'm not going to discredit your feeling that because we haven't had 4 months supply of inventory since 2014, returning back up to 3 months supply of inventory can feel like it is a balanced market, right? This is the real life impact of decades of undersupplying our housing market. And what do I mean by that? Get away from the idea that 4 months supply is balanced. Let's talk about month supply of inventory as an absorption rate, right? If we no longer listed another home in the MLS and we just found buyers until the MLS was empty, it would take 2.8 months, almost three. And the idea behind that really means that there is so much demand, even in this economy where we've been talking about lesser demand. The inventory is so low that given the demand that we have, our inventory would be gone in 3 months. I think that's a more appropriate way to talk about this in the grand scheme of things, because relative to decades ago, where we were admittedly oversupplying the market, you know, that is a different problem. This is not nearly as dangerous, but it is perpetuating a lack of availability and lack of housing affordability that we can solve if we want to have advocacy efforts. And speaking to our advocacy, team and our government affairs committee to make sure that there are more buying opportunities for individuals, right? So, some takeaways here for you, just to save time. I know we're close to the end here. Market pace and inventory. From the buyer's perspective, you may have more time to shop around than last year, but gems still sell fast. Not every home is created equal after all. So stay on top of it. um, Expect this pace to be that new normal, right? That idea that we are, back to this, just because it's still a strong seller's market doesn't mean we're not going to last around here for a while. We are likely going to be at about high 2 to 3 month supply of inventory for months like September. Seller's perspective, it's still a seller's market, right? You're still seeing that demand relative to the inventory that's available in your favor. The pace of the market is going to slow down, but more likely than not, that is slowing down for the season. Um, that is my main takeaway in terms of market pace and inventory. And that is what I got for y'all. We saved you about 8 minutes compared to our normal hourly presentation. I will give it a couple of more seconds in case anybody joining us live has questions for me in terms of anything that I've covered. Um, but just want to do one final pitch since I am stalling for time. If you do have questions, again, our research team is available for you on any business day. We got an email that we both watch pretty consistently. If you have research questions about our tools, research questions about any of our reports coming on, we're trying to work on delivering more data to you in more data-friendly ways. Key version of that. Here, let's hop out of this. Go to the market data homepage. We have that heat map in case you haven't learned about it yet. Always from the when I'm ever actually at the office. We got a little technical glitch here. Here we go. You log in for your market data through the MAR member portal on our website. And you have access to interactive tools to show you North Star MLS data in all sorts of cool ways. You can zoom in and take a look at any city in particular, wow your clients with access to intuitive data to help them make good decisions. You can see where those balanced markets are. Remember how I said not every market is the same? It looks like, let's increase our sales here to 5 so that way we don't get zero numbers. You can see Dayton, their month supply of inventory is 3.6. Edina, 3.3. Maple Grove, 1.8. Very different types of competition happening from one area to another for various reasons, right? We want to make sure that you guys have data available to you 24/7. We're committed to that type of engagement. Please make sure you're reaching out to us. I don't see any other questions. So, with that, I will leave you all here. Thank you so much. I do plan to give another market recap of the 2025 year in January. I will plug my colleague and friend David Arbit, who does a higher level version of this market data presentation on a monthly basis. That's kind of his thing. And if you are interested on that, please go over to Minnesota Realtors website. He's got great data to show you there as well. But until next time, everybody, we will look forward to seeing you then. Bye.